There are a number of ways that small business owners can raise the funds necessary to start their business or take their existing business to the next level, and what type of funding to choose and when can drastically impact the business's success. The most common funding sources include grants, friends and family, traditional loans, peer-to-peer lending sites, crowdfunding sites, credit cards, angel investors, venture capitalists, and business plan competitions. Grants can be a great funding option because the owner is able to gain access to money without giving up ownership or having to pay interest. However, many grant awards severely limit the scope of what the money can be used for and may not be flexible enough for the needs of many small businesses. So make sure that you understand the limitations imposed by any grant before pursuing it. The most common sources of grant funding are the government, large nonprofit organizations, and universities. Friends and family members may be another great option for entrepreneurs, especially those just starting out. Contributions from friends and family vary widely and can include anything from gifts to interest-bearing loans to equity stakes. Even when friends or family require interest payments or equity, the terms that entrepreneurs are able to get are almost always much more favorable than they would receive elsewhere. However, if a business fails and these investors lose their money, the entrepreneur may have caused irreparable damage to close personal relationships. For this reason, entrepreneurs seeking financial support from friends and family should make sure that all involved are clear about the risks and expectations associated with such an investment. Loans are another great funding option for entrepreneurs. By opting for loans, entrepreneurs do not have to give up any ownership in their businesses and remain in full control. However, they must pay back the total amount of the loan plus interest whether or not the business is successful. Additionally, in order to qualify for loans, entrepreneurs must meet certain credit requirements and may be required to provide collateral for the loan. There are two primary sources for loans: banks and peer-to-peer lending sites. Additionally, credit cards are also a form of short-term loans. Banks are the traditional source of loans, and your loan officer will be very experienced in the lending process, so he or she can explain to you the necessary documents and quote an interest rate for you based on your creditworthiness. Peer-to-peer lending sites are websites that serve as intermediaries to help people give and get loans from their peers without having to work directly with a bank. Often, borrowers who are not perfect candidates for bank loans are able to get better interest rates from peer-to-peer lending sites. Whichever loan source you choose, the lender will want to know how you intend to spend the money and to see evidence that your business will be successful so that you will be able to pay them back. Many require a formal business plan, or at least its executive summary, to be willing to make small business loans. Crowdfunding sites such as Kickstarter, Quirky, Indiegogo, and ProFounder have been growing in popularity and are another option for entrepreneurs. Each site varies, but the basic premise is that users post their idea on the site and others can contribute money towards the cost of the endeavor. Terms vary widely from site to site, so make sure that you read the fine print and know what you owe to your backers before taking any money. Additionally, these sites tend to have specific niches, so for the most success, be sure to find the site that fits most closely with your idea and always follow the site rules. A simple Google search for crowdfunding sites will give a number of results to help you find the one that makes the most sense for your endeavor. Business plan competitions are another amazing source of funding for entrepreneurs. Additionally, these competitions are great ways to network, get feedback, and find mentors for your new venture, whether you win or lose. There are tons of business plan competitions every year, with various areas of focus and target groups, and some offer huge prizes to the winners. Again, terms vary, so make sure that you know the details of any individual competition or prize award before signing anything. Finally, angel investors and venture capitalists are possible funding sources for entrepreneurs expecting rapid growth and willing to give up some ownership in their business. Both angel investors and venture capitalists are typically experienced investors that take an equity stake or part ownership in the companies in which they invest. The cash needs of the company drive how much money an investor will invest, and its pre-money valuation drives how much equity will be taken for that investment. While venture or angel investment can provide businesses with a large influx of cash, offer expertise and networking that may be invaluable, and does not require the payment of interest, it does require that entrepreneurs give up some ownership and therefore some control of their businesses. Venture capitalists are career investors who work for investment funds that handle the money of other individuals. Angel investors are wealthy individuals that invest their own money. Both groups are extremely savvy when it comes to investing and can be cutthroat in deal negotiation, VCs typically a bit more so than angels. Additionally, angels and VCs expect a high return in a short period of time, so they typically invest in companies that can go public or be sold to an acquirer within 3 to 7 years. Many review hundreds of companies to find a suitable investment, and a polished, formal business plan is almost always required in order to initiate contact with an angel or VC. These investors are serious, so do not approach an angel or VC until you are ready, because it will be almost impossible to recover from a bad first impression. As you can see, there are a number of funding options for your small business, and which source you approach will depend greatly on the current state of your business and its future goals. The chart shows a timeline of when most businesses typically access the different funding sources. However, this is just a guide, not an absolute. Make sure that you consider all of the positives and negatives of each option before agreeing to any deals, as the wrong type of investment can cripple a company. If you're really not sure what to do, talk to a mentor or other expert to get some advice. I hope you found this tutorial helpful. Best of luck finding funding for your business, and don't forget to subscribe to my YouTube channel and follow me on Twitter for more advice about your new venture.